Welcome to the Two Beans in a Pod. Today, we're diving into something pretty striking that's happening in the markets. This huge surge in gold prices. We've seen it blow past the $4,000 mark recently.
Right, yeah, historic highs. And naturally, whenever gold does something like this, it gets people talking about the big picture, the global financial system, and especially the US dollar's role in it all.
Exactly. Gold's always been seen as that, asset of last resort. So when its price moves this dramatically, you have to wonder if the market's signaling something fundamental. But the question is, what is that signal?
Okay. And, I'll be taking the other side. While I absolutely agree the system has challenges, big ones, well-known ones, I think the dollar's dominance is actually incredibly resilient. My take is that this gold rally, it's mostly driven by factors we understand pretty well, like falling real yields and just general short-term uncertainty, not some imminent system collapse.
Okay, so let me lay out why I think this is structural, this gold surge. It's not just fickle market sentiment, right? It's driven by really measurable, strategic shifts in demand. Look at central banks globally. They're buying well over 1,000 tons a year now.
It's a big number.
It is a big number. It completely dwarfs the historical average. The 20-year average is something like 457 tons. This isn't just tactical hedging. I mean, this scale suggests a deliberate, long-term strategy to diversify reserves. It feels like a conscious move towards, de-dollarization, especially from emerging markets.
I get the focus on the central bank buying, I do. But, these gloomy predictions about the end of the dollar standard, they pop up all the time, don't they? And so far, they've always been wrong. Remember after 2008, the dollar was supposedly finished?
Yeah, I remember. Or when the euro launched. Same story. But despite all those crises, the dollar actually kind of consolidated its dominance. I mean, the BIS data still shows the dollar is involved in 88% of all FX trades globally? The system's proven pretty robust, you have to admit. But those past scares, they didn't have the same combination of pressures we see now. The fiscal side and the geopolitical side hitting at once. And we can't ignore the sort of built-in flaw of the dollar standard itself, this thing called Triffin's dilemma. It's this basic contradiction. The US has to run deficits, both current account and fiscal, to supply the dollars the world needs for liquidity. But doing that over time inevitably chips away at confidence in the dollar's long-term value. It's like a structural catch-22 that pushes towards change eventually.
I prefer to look at the evidence, empirically. Structural arguments sound neat, conceptually, but the actual analysis, the regression work, it shows gold's price moves are really strongly tied to traditional macro factors. The biggest one, it's the negative correlation with real yield.
Okay, explain real yield for folks maybe not familiar.
Right, sure. So real yield is basically the return you get on an investment after accounting for inflation. Think of the yield on TIPS, Treasury Inflation Protected Securities. That's a common measure. When those real yields fall, holding gold, which doesn't pay any yield, becomes less costly in relative terms. So its price tends to go up. A lot of the current price action can be explained simply by falling real yields, which are falling because markets expect the Fed to cut rates eventually. It doesn't have to be about systemic fear.
I see the appeal of that clean macro story, but just looking at correlation, it kind of obscures the why, doesn't it? Why are central banks making these huge moves now? I think the real driver, the thing that's accelerated this, is the way the dollar has been used geopolitically. The weaponization of finance, the sanctions, the talk about seizing assets, especially after the sanctions on Russia, that fundamentally changes how countries think about risk, especially sovereign wealth funds. Gold is really the only major asset that sits completely outside the US financial plumbing. That explains this deliberate shift to something tangible, something non-sovereign.
That's a fair point about the politics. It's definitely provocative. But okay, if sovereign funds are truly fleeing the dollar, where are they running to? They need a credible alternative, right? A real reserve currency needs, at least three things: full convertibility, deep and liquid capital markets, and critically, the rule of law. The main contender people talk about, the Chinese yuan, it doesn't really tick any of those boxes convincingly yet. The US, despite its fiscal issues, still offers this package: rule of law, relative political stability, unmatched market depth that others just can't match. So I'd argue the geopolitical anxiety around sanctions might actually, ironically, reinforce the need for existing safe havens, even if it creates some friction.
But the lack of a perfect replacement right now doesn't mean the structural problem disappears. It just means the solution might look different. It might be more institutional, more technological, not just swapping one currency for another. Look at the work being done on central bank digital currencies, CBDCs. That could lay the groundwork for a promising alternative to the current system. Plus, there are these new ideas floating around for international payments, like a totally revamped special drawing right, the SDR.
Right, the SDR, that's the IMF's basket of currencies.
Exactly. And a radical SDR, as some call it, could become a genuine global reserve asset, managed internationally, specifically designed for a multi-currency world. These aren't just pipe dreams, they're laying the foundations for an eventual reset, I think.
I'm skeptical that these tech developments mean change is right around the corner. Central bankers are, let's be honest, a pretty conservative bunch. Their main goal is do no harm. CBDCs have huge potential, theoretically, sure, but actually implementing a cross-border system that could seriously challenge the dollar, that feels years away, maybe decades. And historically, these transitions between reserve currencies, Venice, Spain, the Dutch, the British, then the US, they've always been incredibly slow, often messy, tied to huge geopolitical shifts, even wars, and decades of changing economic power. The dollar isn't just going to fade away quietly. It would likely take some really drastic, really provocative actions by the US government itself to truly force a rapid shift away from dollar reliance.
Okay, let's just take a quick pause here. We want to encourage everyone listening, if you're finding this discussion valuable, please do hit that like button and consider subscribing to the program. It really helps us keep bringing you this kind of analysis.
Yeah, absolutely. Your support makes a difference.
All right, so picking back up on the fiscal point, I really believe the pace of this is being forced by worries about U.S. finances. This gold surge fundamentally is the market pricing in the risk that the U.S. fiscal situation, which looks pretty unsustainable, let's be real, will eventually force the government towards, printing money to handle the debt. That makes gold look like the better store of value long term. I mean, we saw the debt to GDP ratio actually tick up recently, even with strong inflation. When inflation doesn't even dent your debt ratio, people lose faith in fiscal discipline and they look for tangible assets.
That's definitely a concern, the fiscal path. But again, gold's current behavior fits neatly within the pattern of sort of cyclical economic confusion, which doesn't require a systemic collapse narrative. Look at the data right now, it's all over the place. The labor market seems to be cooling off a bit,
Right.
but GDP growth has been strong and inflation is sticky. It's a mixed bag, and that kind of mixed data creates huge uncertainty about what the Federal Reserve is going to do next. When or if they'll cut rates. And that uncertainty directly impacts real yields, which we've established as a primary driver for gold, without needing to assume the U.S. is on the verge of fiscal ruin.
But focusing only on the cycle misses the long-term hedging aspect, doesn't it? That seems to be what the sovereigns are focused on. Sure, gold's link to inflation might be weak short-term, but over longer periods, like 20 years, that correlation gets much stronger. Big institutional players, central banks included, they understand that. They're hedging against the structural, long-term inflation risk that comes from what looks like perpetual U.S. fiscal issues. That's a risk that these short-term arguments about the next Fed meeting just don't fully capture.
Okay, if we're talking long-term risk and market faith, we have to look at the biggest, arguably most professional market out there, the bond market. If the smart money in bonds really expected the kind of hyperinflation that would crater the dollar, we'd see it screaming from the rooftops in the data. Take the 5-year forward break-even inflation rate. It's a mouthful, but it basically shows what the bond market expects inflation to average way out in the future, like 5 to 10 years from now.
And what's it showing?
It's been remarkably stable, still hovering pretty close to the Fed's 2% target. Bond investors, the people with the most skin in the game if the dollar gets debased, they just don't seem to be pricing in the kind of collapse scenario you're suggesting.
See, that bond market stability, that might be the exact blind spot I'm talking about. Bond markets are notoriously slow to price in complex geopolitical risks or long-term fiscal rot. They focus on the next few data points, But the central banks, the ones physically moving reserves out of treasuries and into gold at record speed, they aren't waiting for that forward break-even rate to flash red before they act. Their actions, buying 1,000 tons of physical gold, that speaks volumes. Much louder, perhaps, than the stable pricing in a market that's missed big systemic risks before.
Yet, we can't just dismiss the system's built-in resilience. The dollar's global role, sometimes called a financial amplifier, means its ups and downs actually help manage global economic activity. When the dollar weakens, for instance, it can sometimes act like a pressure valve, easing conditions elsewhere. Its very centrality allows it to absorb shocks and correct imbalances, which kind of reinforces its role rather than signaling its end.
So wrapping up my view, I think this sustained, powerful rally in gold is really telling us something important. It suggests the market is seriously pricing in these long-term geopolitical and fiscal dangers, reflecting a fundamental unease with the dollar standard. Now, look, this shift won't happen instantly. These things take time, they evolve, but the combination of what central banks are doing, the strategic buying, and this push for new currency alternatives, it strongly indicates the system is eroding, heading towards a necessary, even if slow, kind of reset.
And from my perspective, while the dollar definitely faces real, well-documented structural issues, the evidence just shows its dominance is still firmly in place. Why? Because the alternatives simply aren't ready. They lack the depth, the trust, the legal framework. Gold's rally, as dramatic as it is largely explained by factors we know and can measure. Its strong negative link to low real yields and the general jitters caused by short-term uncertainty. The market's nervous about the Fed's next move, sure, but not necessarily about the fundamental survival of the U.S. economic system. The dollar system is resilient.
Well, we've certainly laid out the two sides of this. On one hand, the view that gold's surge is a flashing warning light for the dollar's future, signaling deep structural cracks. And on the other, the perspective that it's more like turbulent but ultimately normal weather within the existing global financial climate, driven by familiar factors like interest rates and volatility.
Right. It really highlights how the underlying tensions in the international money system are playing out right now in the gold market. It leaves us all to weigh the evidence. Is it just noise, or is it a signal of profound change?
A fascinating debate indeed. Thank you for joining us on this exchange. If you appreciated this discussion, please do hit that like button and subscribe so you don't miss our future programs.
Thanks for tuning in.
Thank you for listening to Two Beans in a Pod.